Friends send ideas my way all the time, which to be honest is a great source for ideas. When someone brings you their best conviction pick, it means it has gone through a few filters. So far, I have only invested once in a company a direct friend has recommended. And not because they are bad ideas or picks, but really I do like a company in general. So I've come to the conclusion that sometimes the best answer is, it's not for me. It comes from my strong belief that conviction cannot be externalized. You cannot rent it, you cannot buy it. If you can build your own conviction in the idea, it won't work. So if it's outside my circle, if the leverage is too high, if the business model seems unsolid, then I educatedly point it out and say, it's just not for me. Best of luck. Thanks for the tip, and that's it. They do the same with my ideas. I actually prefer them doing that. I don't love it when people invest in my ideas. I can't sustain 90+% losses if the thesis still holds, but I cannot lend that conviction to someone else. So I suffer more for others than myself. Today I will run through a few of my friends' ideas, new picks, see why I discard them or not, and maybe in doing so I will change my mind. The first one is VFF, Village Farms International Incorporated, a cannabis play that exited a loss-making vegetable business and went pure play cannabis, simplifying everything. They have 30 years of experience in agriculture that they started to switch in 2018 to the cannabis. The company trades on the Nasdaq as its US operation are hemp only. Other cannabis players in the US have to list elsewhere as it's illegal under federal law. So they do cannabis elsewhere and hemp in the US. Net sales pro forma only cannabis were 193 million in 2024. Negative margins, but after exiting the loss-making vegetable business and expansion to the Netherlands with higher margin, it should be positive. 5 million sales annualized in the Netherlands and set to quintuple capacity in less than a year. The other thing running for the thesis is the possible federal US legalization that might allow their hemp Texas production to switch to cannabis, with the US listing already in place. That could make the business really go to the moon. The problem, I do not like the cannabis business, so political and illegal in most of the world with continuously changing regulations. Of course, you and I can see the long-term trend of legalization, but the players, dynamics, timeline, margins, and modes are way outside my mental capacity. So I passed. It's just not for me today. Let's also say today, because I'm open to changing my mind, but I have a thick skull, so it can take a lot to do so. And DAVA was another pick, a digital transformation and software engineering firm based in the UK. It's trading under the ticker DAVA, D-A-V-A, in the New York Stock Exchange. They did $780 million trailing 12 months and $20 million in profits, which to me, with all the technological risk, seems like a very low margin. The price with the debt is around 1 billion. They have had a rough 2024 as these companies require a lot of growth to justify their valuation. Also, AI integration has pushed their costs up, which to me it was actually surprising and made the read more interesting. Of course, I didn't spend a lot of hours in this idea, as from the usual companies I pick, it's a bit different. And DAVA might be a great company, but it is one that falls outside my circle of competence. You have heard me talk about naked tech before. It's a rule that I have. I don't invest in companies without a physical backing that protects the business. You could say that, for example, Baba is tech or Carvana is tech, but one has a ridiculous product logistics enterprise as well as a cloud server infrastructure, among other things, which are very expensive to replicate. Carvana, same thing. They have physical, costly, hard to replicate parts that protect the business. So DAVA, even a great company it might be, falls in that category for me. It's just not for me. Might be great for you though, so take a look. Another one is gambling.com, a super growth company, super high margin lead generator for the gaming casino industry, especially in the US. They do that through SEO, content, affiliate partnership, and subscription services. It is listed in the Nasdaq under ticker GAMB, and the valuation including debt is 500 million. Revenues were 138 million and margin in this one are really high, and this is very asset light, with $38 million of profit pre-tax and growing at a strong clip with bolt-on acquisitions. They operate websites that drive traffic into the casinos for a price. And here's where you could say that owning the website has a moat. And sure it does, we agree here, but the strength of the moat is what worries me. As soon as Google changes the algorithm, their privacy policy, or even pricing, it can completely change your competitive advantage in a second. Now think about competitors. They can keep creating websites at no cost or dumping money in the offers just to displace you. If they have deep enough pockets, you can be making no money for a long time. Again, not for me. Check for yourself. Now ASTS in the Nasdaq too. AST Space Mobile Incorporated, a new technology for space-based cellular broadband network that connects directly with unmodified smartphones, making you not lose connection even in the most remote areas across the globe. The TAM, the total addressable market, is ridiculous, in the many billions, according to them. All major carriers in the world are backing the company, totaling 3 billion subscribers, and the sky is literally the limit. We could say as of today it's pre-revenue, but trades at a pretty penny with $11 billion valuation. And my problem starts here. Doing other than a lot of guessing, I don't know how someone can value this company. Today we just have no idea for the margins. We have no idea for the pricing. Well, instead of we have, let's say I don't have. I have no idea if in 2 years there's new technology that makes this obsolete. I have absolutely no idea. On ASTS, I have actually spent some time, but in the end, yes, everything looks so good, but I have to be honest and protect myself from myself. Me or literally anyone truthful have no idea on what this company looks like in 5 years or even 10 years. And to invest, I need to at least truly believe I have some sort of idea. So not for me, but a lot of potential, and this one has at least some very physical backing with all the tech. I do wish it works, as some friends have good money in it. Okay, into calls. Ticker KSS on the New York Stock Exchange and trades for $1 billion, but really with the 3.5 billion. Kohl's is the biggest department store retailer in the US by number of locations. If you live in the US, you know what it is. And it is at a crossroads. And you kind of need to pick a side for this struggling retailer, in my opinion. There's a desperate turnaround play or a real estate liquidation gamble. But the problem is that you can't have both. First, the elephant in the room. Kohl's has over 1,100 locations across America, and they own around 400 of those. That's a massive footprint, but is it an asset or an anchor? There are multiple investors and forums arguing all kinds of valuations from 4 billion to 11 billion, and I say, okay, let's believe it's the latter, 11 billion. They generate $16 billion from those stores, but margins are paper thin. Path 1 is a turnaround. New leadership, better margins, maybe even a return to growth, but let's be real, department stores are brutal. Low margin, cutthroat competition, and Kohl's has no real moat compared to peers. Path number 2, the real estate play. Tear a page from Sears playbook. Sell off the land and buildings, liquidate and cash out. But here's the catch. These strategies clash. The turnaround needs the stores open. The liquidation shuts them down, so you gotta choose. Now some investors whisper about the best of both worlds scenario. Hope for the turnaround, but if it doesn't work, let's go to the real estate play. Sounds smart, but it's a bit dangerous. Why? Because failed turnarounds don't stand still. They bleed cash, they take many years, and by the time you pivot to the planned real estate, the assets might be worth far less. Take a look what happened to Sears shareholders. Let's diagnose the patients. Kohl's has decent gross margins, better than many peers, but between operating costs and debt, they are barely breaking even. For context, Walmart runs at half the gross margin, but double the profit. Scale does matter. The CEO was just fired over ethics violations, and there's an interim leader now. But if you see most of the previous year thesis, they were banking on the leaving CEO for the transformation. And while margins have crept up since COVID, we are talking pennies, not the 5% margin that could justify a higher stock price. Oh, but the real estate. On paper, gold trades at just 30 cents for every dollar of assets, and some people say 11 billion is a very conservative measure. Tempting, but subtract the debt and the math gets a bit fuzzy. Management isn't even whispering about liquidation. Take a look at any presentation, any report, they say nothing. There's no real activist pressure either, so no one is willing to sell. So who will sell this? Unless this business collapses, and I mean Sears level collapse, these properties are locked up. And bankruptcies, they are messy, unpredictable, and rarely pay off, especially for equity holders. There's a silver lining, which is that less than 3 years ago, this currently trading $9 stock was offered $64, and the management rejected it. I'm sure it's not worth $9, but who knows what we can get in a forced liquidation. So, okay, if you love turnarounds, you need blind faith in the leadership team that really doesn't exist yet. If you are betting on real estate, you are waiting for a crisis that may never come. Personally, I don't like the business. And the business sort of needs a miracle. And without a clear catalyst, gold feels like a hopping Hail Mary. But hey, if you see something I don't, drop in the comments. Let's debate. I'd like to see where this $55 difference went in under 3 years. And if we can get any of that back, the returns look absolutely great. For now, I just believe the management is just not for it. And for the traditional department store model, it's me. I'm not for it. Well, that's it for me today. Feel free to comment your highest conviction pick if you want me to cover them, or subscribe and share if you like the content. See you in the next video. Take care, be safe.